you know the secret weapon for low-cost investing? Unveiling the power of VTI ETF. Hey everyone, welcome back to Chat ETF. Today we're diving deep into a powerhouse player in the world of ETFs, the VTI. But before we jump in, raise your hand, or hit that thumbs up button, if you're looking for a way to invest in the entire U.S. stock market without the hassle. That's what the VTI is all about, a simple, low-cost way to spread your bets across thousands of U.S. companies. But is it the right choice for you? Buckle up, because in the next few minutes, we're cracking the code on the VTI, exploring its pros, cons, and whether it can be the secret weapon in your investment arsenal. Stay tuned. Question 1. What is VTI ETF? VTI ETF, also known as the Vanguard Total Stock Market ETF, is an exchange-traded fund, ETF, designed to track the performance of the entire investable U.S. stock market. Here's a breakdown of what that means. Core characteristics. Tracks a broad market index. VTI aims to mirror the performance of the CRSP U.S. total market index. This index encompasses a massive number of stocks, typically exceeding 3,900 companies. Highly diversified. By holding such a vast array of stocks, VTI offers significant diversification. This means your investment isn't tied to the success of a single company or a small group of companies. Diversification helps spread risk and aims for steadier long-term growth. Market cap weighted. VTI uses a market capitalization weighted approach. Simply put, the holdings with the largest market value, total stock price multiplied by outstanding shares, have a bigger influence on the fund's overall performance. Companies like Apple, Microsoft, and Alphabet are typically among the top holdings due to their large market caps. Passively managed. VTI is a passively managed fund. This means it doesn't try to outperform the market by actively picking stocks. Instead, it aims to replicate the holdings and performance of the underlying index, CRSP U.S. total market index, as closely as possible. Question 2. What is the VTI ETF's primary investment objective? The VTI ETF's primary investment objective is to track the performance of the entire U.S. stock market as closely as possible. This translates to mirroring the returns, both growth and decline, of the CRSP U.S. total market index, which it uses as its benchmark. Here's a deeper dive into VTI's objective. Market replication, not outperformance. Unlike some actively managed funds that aim to beat the market, VTI doesn't focus on selecting stocks that outperform the average. Its goal is to passively replicate the holdings and performance of the CRSP U.S. total market index. Broad market exposure. By achieving this objective, VTI grants investors exposure to a vast range of U.S. companies across various sectors and market capitalizations, large, mid, and small cap. This diversification helps spread risk and aims to provide a representation of the overall U.S. stock market's performance. Long-term growth potential. The historical trend of the U.S. stock market suggests a general upward trajectory over the long term. VTI, by tracking the entire market, offers the potential to benefit from this long-term growth, albeit with the inherent fluctuations of the market. Question 3. Does the VTI ETF track a specific index? Yes, the VTI ETF specifically tracks the performance of the CRSP U.S. total market index. This index serves as the benchmark for VTI's holdings and overall performance. Here's a breakdown of the relationship between VTI and the CRSP U.S. total market index. Index as blueprint. The CRSP U.S. total market index functions like a blueprint for VTI. The index includes a vast number of U.S. stocks, typically exceeding 3,900 companies, across various market capitalizations, large, mid, and small cap. Passive management. VTI, being a passively managed ETF, strives to replicate the holdings and performance of this index as closely as possible. This means VTI's portfolio composition will mirror the index's composition, with holdings weighted proportionally to their representation in the index, market cap weighting. Performance alignment. By mimicking the index, VTI aims to deliver returns that closely resemble the overall performance of the U.S. stock market, as reflected by the CRSP S. Total market index. This includes both potential growth and decline, depending on market conditions. Benefits of tracking a specific index. Transparency, the use of a well-established index, like the CRSPU. S. Total market index allows for transparency in VTI's holdings and investment strategy. Investors can readily understand the types of companies and market segments the ETF is exposed to. Performance benchmark, tracking a specific index provides a clear benchmark to assess VTI's performance. Investors can compare VTI's returns against the CRSPU. S. Total market index to identify any tracking errors, differences between the fund's performance and the index. Passive management efficiency, following a specific index allows VTI to leverage a passive management approach. This translates to lower expense ratios compared to actively managed funds, ultimately benefiting investors with potentially higher returns. Question 4. How has the VTI ETF performed in different market conditions? VTI, by design, tracks the performance of the entire U.S. stock market, reflected by the CRSPU. S. Total market index. Therefore, its performance is inherently tied to the market's overall health and will fluctuate across different market conditions. Here's a breakdown of how VTI typically behaves in various market scenarios. Bull markets, rising markets. Positive performance. During bull markets characterized by rising stock prices, VTI tends to experience positive returns. As the underlying companies within the CRSPU S total market index increase in value, the value of VTI shares typically rises proportionally. Mirroring market gains, the extent of VTI's growth aligns with the overall market's upward trend. While VTI might not outperform all individual stocks in a bull market, it aims to capture the broad market's positive momentum. Bear markets, declining markets. Negative performance. When the stock market enters a bear market with declining prices, VTI's value is likely to decrease as well. The holdings within the CRSPU S total market index will experience price drops, impacting the overall value of the ETF. Reflecting market downturns, VTI serves as a mirror to the market, and during downturns, it reflects the negative sentiment. Investors shouldn't expect VTI to be immune to market corrections or crashes. Volatile markets. Increased fluctuations. Volatile markets characterized by significant swings in stock prices can lead to more pronounced fluctuations in VTI's value. The ETF's price will likely experience greater volatility, reflecting the underlying market's uncertainty. Amplified movements. Since VTI holds a vast number of companies, some might perform better or worse than others during volatile periods. This can lead to amplified price movements in the ETF compared to less diversified holdings. Important considerations. Long-term focus. VTI is designed with a long-term investment horizon in mind. While it might experience fluctuations in different market conditions, historically, the U.S. stock market has exhibited an upward trend over extended periods. Diversification matters. VTI's strength lies in its diversification across various sectors and companies. This helps mitigate risk compared to investing in individual stocks that might be more susceptible to specific market events. Understanding risk tolerance. Investors should be comfortable with inherent market risks when considering VTI. While it offers broad exposure, it doesn't guarantee positive returns in all market conditions. Question 5. What are the key risks associated with the VTI ETF's investment strategy? VTI, despite its diversification and low-cost approach, comes with inherent risks associated with its investment strategy. Here's a breakdown of the key risks to consider. Market risk. Core risk. The most significant risk for VTI is market risk. Since VTI tracks the entire U.S. stock market, its performance is directly tied to the overall market's health. If the stock market experiences a downturn, bear market, the value of VTI will likely decline as well. This can lead to significant losses for investors, especially those with a short-term investment horizon. Tracking error. Imperfect replication. While VTI strives to mirror the CRSPU S total market index, it might not achieve perfect replication. Tracking error refers to the difference between the ETF's performance and the index's performance. This can arise due to various factors like expense ratios, fees associated with buying and selling underlying securities, and cash drag. cash holdings within the ETF that don't generate returns. While typically minimal, tracking error can slightly diminish VTI's returns compared to the index. Lack of outperformance potential. Market match, not market beat. VTI's passive management strategy prioritizes replicating the market, not exceeding it. Investors shouldn't expect VTI to consistently outperform the market or pick individual winning stocks. This might be a drawback for those seeking aggressive growth strategies. Sector concentration risk. Market weighting impact. VTI uses market capitalization weighting. This means companies with larger market caps have a more significant influence on the ETF's overall performance. If certain sectors experience a downturn, and those sectors are heavily represented in VTI due to their market cap size, the ETF's value can be disproportionately impacted. Other considerations. Limited liquidity for small-cap holdings. While VTI offers exposure to a wide range of companies, some holdings might be small-cap stocks with lower trading volume. This can lead to lower liquidity, making it slightly more challenging to enter or exit positions quickly at the desired price. Geopolitical and economic events. Global events and economic uncertainties can significantly impact the stock market. Since VTI is tied to the overall market, these external factors can contribute to price fluctuations and potential losses for investors. Risk management strategies. Long-term investment perspective. VTI is ideally suited for a long-term investment approach. Historically, the U.S. stock market has recovered from downturns, and VTI's broad diversification can help weather market fluctuations over time. Portfolio diversification, including VTI as part of a broader portfolio that incorporates other asset classes, e.g., bonds, real estate, can help manage risk. This reduces reliance solely on the stock market's performance. Understanding risk tolerance. Investors should honestly assess their risk tolerance before investing in VTI. While it offers growth potential, it's not immune to market downturns. Question 6. Does VTI ETF contribute to portfolio diversification? Absolutely, the VTI ETF can significantly contribute to portfolio diversification, and here's why. Broad market exposure. VTI tracks the entire U.S. stock market through the CRSP U.S. total market index. This translates to investing in a massive number of companies across various sectors and industries. By doing so, VTI avoids placing all your eggs in one basket and reduces your reliance on the performance of a single company or sector. Reduced company-specific risk. When you invest in individual stocks, your portfolio success hinges heavily on the performance of those specific companies. If a company you own experiences a downturn, your portfolio value can take a significant hit. VTI eliminates this risk by spreading your investment across a vast array of companies. Even if a few companies within VTI underperform, the overall impact on your portfolio is likely to be lessened due to diversification. Mitigated sectoral risk. Markets can experience sector-specific downturns. For instance, a tech stock slump might not significantly affect companies in the healthcare sector. VTI's diversification across various sectors helps buffer your portfolio against such sectoral risks. If one sector experiences a decline, the positive performance of other sectors within VTI can potentially help offset some of those losses. Market capitalization coverage. VTI encompasses large, mid, and small-cap stocks. This provides exposure to companies at different stages of growth, offering a more well-rounded representation of the market. While small-cap stocks can be more volatile, their inclusion alongside established large-cap companies helps balance the risk-reward profile within VTI. Comparison to non-diversified holdings. Imagine holding just a handful of individual stocks. The performance of your portfolio would be heavily dependent on those few companies' success. VTI, on the other hand, offers a significantly more diversified basket, reducing reliance on any single company or sector. Limitations to consider. Market-driven performance. While diversification helps, VTI's performance remains tied to the overall stock market. If the entire market experiences a downturn, VTI will likely decline as well. Focus on U.S. market. VTI solely focuses on the U.S. stock market. If you seek broader geographical diversification, you might need to consider additional investments beyond VTI. Question 7. Are there other ETFs with similar objectives of VTI ETF but lower expense ratios? Yes, there are a few ETFs with similar objectives to VTI, tracking the total U.S. stock market, but with slightly lower expense ratios. Here's a comparison. Schwab U.S. Broad Market ETF, SCHB, expense ratio 0.2% as of March 26, 2024. SCHB tracks the Dow Jones U.S. Total Stock Market Index, offering exposure to a similar universe of U.S. companies as VTI, around 3,600. This minor difference in the index shouldn't significantly impact performance compared to VTI. iShares Core SP Total U.S. Stock Market ETF, ITOT, expense ratio 0.9% as of March 26, 2024. It tracks the SP Total U.S. Stock Market Index, encompassing roughly 3,500 companies. While the expense ratio is slightly higher than SCHB, it's still lower than VTI. Important considerations. Minimal expense ratio difference. The expense ratio difference between VTI, 0.3%, and these alternatives, SCHB, at 0.2% and ITOT at 0.9%, is relatively small. This means the overall impact on long-term returns might be negligible. Tracking index variations. While all three ETFs aim for broad U.S. market exposure, they track slightly different indexes. This can lead to minor performance variations over time. However, these differences are typically insignificant for most investors. Underlying holdings. There might be slight variations in the specific companies held within each ETF due to the indexes they track. This can lead to microscopic differences in sector weightings. Choosing between VTI, SCHB, and ITOT. Cost focus. If the absolute lowest expense ratio is your top priority, then SCHB might be the most attractive option. Minimal difference. For many investors, the small expense ratio difference between these ETFs might not be a significant deciding factor. Other considerations like familiarity with the fund provider or investment platform availability might be more important. Beyond expense ratios. Tax implications. Depending on your investment account type, tax implications might influence your choice. Consider factors like tax efficiency and potential tax benefits within certain account types. Investment strategy. Align your ETF selection with your overall investment strategy and goals. While these ETFs offer similar objectives, they might fit differently within your broader portfolio allocation. Question 8. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, it's possible to achieve a similar outcome to VTI with a combination of individual stocks or other ETFs. This approach offers potential benefits like lower costs or greater control, but also comes with added complexity and management requirements. Here's a breakdown. Potential advantages. Lower overall costs. If you meticulously select individual stocks with inherently lower expense ratios compared to VTI, 0.3%, you could potentially achieve lower overall costs. However, this requires significant research and analysis to identify suitable stocks. Greater control. By choosing individual stocks or a targeted combination of ETFs, you can exert more control over your portfolio's composition. You can tailor your holdings to align with specific sectors, investment themes, or company beliefs you favor. VTI offers broad market exposure, which might not align with your individual investment preferences. Tax efficiency. Strategic selection of individual stocks or tax-efficient ETFs could potentially lead to tax optimization within certain account types. This requires understanding tax implications associated with different investments. Challenges to consider. Increased complexity. Managing a portfolio of individual stocks or multiple ETFs demands significantly more research, analysis, and ongoing monitoring compared to holding a single ETF like VTI. You'll need to stay informed about market trends, company news, and individual stock performance. Risk of underperformance. Achieving similar or superior returns to VTI through individual stock picking or a complex ETF combination is challenging. Active management requires skill, time, and ongoing effort. The historical data suggests that a significant portion of actively managed funds underperform the market over the long term. Diversification challenges. Constructing a well-diversified portfolio with individual stocks requires a substantial number of holdings to mitigate company-specific risk. This is difficult and time-consuming to achieve effectively. Using a limited number of stocks exposes your portfolio to greater risk compared to VTI's diversification. Transaction costs. Frequent buying and selling of individual stocks or ETFs can incur transaction costs, commissions, fees that can erode returns. These costs are minimal or non-existent with VTI. VTI versus individual stocks/ETFs, a trade-off. Simplicity versus control. VTI offers a simple, low-maintenance approach with broad market exposure. Individual stocks/ETFs provide more control but demand more effort and expertise. Cost versus performance. VTI has a low expense ratio, but individual stock selection has the potential for lower costs if done meticulously. However, achieving similar or superior returns is challenging. Diversification versus focus. VTI offers instant diversification. Building a diversified portfolio with individual stocks requires significant effort. A targeted ETF combination can offer some diversification but might not be as comprehensive as VTI. Question 9. What are the pros and cons of this VTI ETF compared to similar options? Here's a breakdown of the pros and cons of VTI ETF compared to similar options like SCHB, Schwab U.S. Broad Market ETF, and ITOT, iShares Core S.P. Total U.S. Stock Market ETF. Pros of VTI. Low expense ratio. VTI boasts a remarkably low expense ratio of 0.3% as of March 26, 2024. This translates to keeping more of your returns compared to funds with higher expense ratios. Highly diversified. VTI tracks a massive index, CRSP U.S. Total Market Index, encompassing a vast number of U.S. companies, typically exceeding 3,900, across various sectors and market capitalizations, large, mid, and small cap. This diversification helps spread risk and aims for steadier long-term growth. Established track record. VTI is a well-established ETF with a long history of tracking the U.S. market. This provides investors with confidence in its strategy and historical performance. Transparency. VTI's holdings are publicly available due to its use of a well-recognized benchmark index, CRSP U.S. Total Market Index. Investors can readily understand the types of companies they're gaining exposure to. Cons of VTI, compared to similar options. Slightly higher expense ratio. While VTI's expense ratio is low, SCHB offers an even lower expense ratio of 0.2%. This minor difference might be negligible for some investors, but cost-conscious ones might find SCHB attractive. Slight tracking index variance. VTI tracks the CRSP U.S. Total Market Index, while SCHB tracks the Dow Jones U.S. Total Stock Market Index, and ITOT tracks the SP Total U.S. Stock Market Index. These subtle index differences can lead to minor performance variations over extended periods. Pros of similar options. SCHB ETFs. Potentially lower expense ratio. As mentioned earlier, SCHB boasts an even lower expense ratio than VTI. ETF's expense ratio is slightly higher than VTI but lower than the average passively managed fund. Track recognized market indexes. Both SCHB and ITOT track widely recognized market indexes, Dow Jones and SP, similar to VTI's use of the CRSP U.S. Total Market Index. This provides transparency in their holdings. Cons of similar options. SCHB ETFs. Minimal expense ratio difference. The expense ratio difference between VTI and these alternatives is very small. The impact on long-term returns might be negligible for most investors. Slight tracking index variations. Similar to VTI, both SCHB and ITOT track slightly different indexes, leading to potential minor performance variations over time. These differences are typically insignificant for most investors. Overall, when choosing between VTI, SCHB, and ITOT, the key considerations are minimal. All three offer broad S. Market exposure with low expense ratios. Here's a quick guide. Focus on expense ratio. If the absolute lowest expense ratio is your top priority, then SCHB might be the most attractive option. Minimal difference. For many investors, the small expense ratio variations between these ETFs might not be a significant deciding factor. Other considerations like familiarity with the fund provider or investment platform availability might be more important. Established track record. If a long history and established track record are important to you, then VTI might be a good choice. Question 10. What are the potential benefits and drawbacks of investing in VTI ETF compared to individual stocks within the same sector? Investing in VTI offers several benefits compared to picking individual stocks within the same sector. Diversification. VTI tracks a broad market index, providing exposure to a vast number of companies across various sectors, including the one you're interested in. This diversification helps spread risk. If a few companies within your chosen sector underperform, the impact on your overall portfolio is likely to be lessened compared to holding just a handful of individual stocks. Reduced risk. By not relying on the success of a single company or a small group of companies, VTI reduces company-specific risk. If a company you own experiences a downturn, your portfolio value can take a significant hit. VTI eliminates this risk by spreading your investment across a vast array of companies. Lower management requirements. VTI is a passively managed ETF. This means you don't need to spend time researching individual companies, analyzing their financials, and actively monitoring their performance. VTI takes care of tracking the market for you. Lower costs. VTI boasts a very low expense ratio, typically around 0.03%. This means a smaller portion of your returns goes towards fees compared to the potential costs associated with buying and selling individual stocks, commissions. However, there are also some drawbacks to consider when choosing VTI over individual stocks. Limited control. With VTI, you don't have control over the specific companies you invest in. The ETF holdings are determined by the underlying index it tracks. While VTI offers exposure to your chosen sector, you might miss out on potential outperformance from specific companies you believe in. Capped potential gains. While VTI aims to track the overall market performance, it might not outperform specific sectors or individual stocks within your chosen sector that experience exceptional growth. VTI's focus is on broad market representation, not exceeding market returns. Limited tax optimization opportunities. Depending on your account type, individual stock selection might offer some tax optimization possibilities through strategic buying and selling. VTI doesn't provide this level of control over tax implications. Question 11. Would adding VTI ETF improve the portfolio's diversification or potentially increase concentration risk? In most cases, adding VTI to a portfolio would improve diversification and reduce concentration risk. Here's why. VTI's diversification power. Broad market exposure. VTI tracks a vast index encompassing a significant number of U.S. companies across various sectors and market capitalizations, large, mid, and small cap. This inherent diversification is its core strength. How VTI reduces concentration risk. Reduced reliance on single holdings. If your portfolio currently focuses on a limited number of holdings, even within a specific sector, adding VTI reduces your dependence on the performance of those few companies. VTI's diversification spreads your investment exposure across a wider range of companies, mitigating the impact of any single company's underperformance. Sectoral balance. Even if your portfolio leans towards a particular sector, VTI offers exposure to numerous other sectors. This helps balance your overall portfolio allocation and reduces the risk associated with a downturn in your chosen sector. Scenarios where concentration risk might increase. Overweighting VTI. While VTI promotes diversification, adding too much VTI to a portfolio already heavily invested in U.S. stocks might not significantly improve diversification. In such cases, exploring international stock ETFs or other asset classes, e.g., bonds, real estate, might be more beneficial. Sector overlap. If your existing portfolio holdings significantly overlap with the sectors VTI heavily invests in, the diversification benefit might be diminished. Analyze your current holdings and VTI sector weightings to assess potential overlap. Overall impact on diversification. Generally positive. In most cases, adding VTI to a portfolio, regardless of its current holdings, will enhance diversification and reduce concentration risk. VTI's broad market exposure acts as a diversifier, mitigating the risk associated with relying on a limited number of holdings or specific sectors. Alright everyone, that's all the time we have for the VTI ETF today on Chat ETF. So, to recap, the VTI offers a low-cost, convenient way to gain exposure to the entire U.S. market through a single holding. It's a diversification powerhouse that can help reduce risk and smooth out portfolio bumps. But remember, it's not a one-size-fits-all solution. Consider your investment goals, risk tolerance, and whether you prefer a hands-off approach or want more control over your portfolio holdings. If you're curious about learning more about ETFs or building a well-diversified portfolio, hit that subscribe button and smash the notification bell so you never miss a video. We've got tons of content to help you navigate the exciting world of ETFs. Thanks for joining us today. We'll see you on the next one.